This week, global oil prices dipped after a strong start, signaling a pause in recent market optimism. On July 8, 2025, Brent crude fell by 21 cents to $69.37 per barrel, while West Texas Intermediate dropped 24 cents to $67.69. The decline followed a nearly 2% surge the day before, driven by hopes for robust U.S. summer fuel demand. But optimism faded as new concerns emerged, especially around global trade and energy supply. Two main forces drove the price dip: President Trump's announcement of new U.S. tariffs and OPEC Plus's decision to boost oil production. The tariffs threatened to slow global economic growth and reduce oil demand, while OPEC Plus's production increase adds downward pressure on prices. The market now faces a delicate balance between these bearish developments and still strong U.S. demand. All eyes are on which force will shape oil prices in the weeks ahead. President Trump's announcement of aggressive new tariffs, effective August 1, 2025, marks a significant turning point in U.S. trade policy. The move is part of a broader strategy to protect American industries and jobs, but it comes with far-reaching consequences for the global economy. The news sent shockwaves through global markets, triggering immediate volatility as investors scrambled to assess the impact. Stock indices around the world tumbled, reflecting deep concerns about the future of international trade and economic growth. The tariffs target a wide range of imports, escalating trade tensions and creating uncertainty for businesses and governments worldwide. Companies that rely on cross-border supply chains now face higher costs and potential disruptions, forcing them to rethink their strategies. A July 9th deadline was set for countries to negotiate, putting pressure on U.S. trading partners to make concessions or face economic fallout. The clock is ticking, and the stakes are high for both allies and rivals. For oil markets, the threat of a trade war is a major red flag. Tariffs slow global growth and energy demand. As economies brace for potential slowdowns, the ripple effects are felt across the energy sector. Higher costs and reduced trade mean factories and transport networks use less fuel. This decline in industrial activity directly impacts oil consumption, adding to the downward pressure on prices. The mere announcement of these tariffs was enough to push oil prices down, as traders braced for weaker demand. The uncertainty has made markets more sensitive to any news about trade negotiations or policy changes. Investors now face heightened political risk and uncertainty about how other countries will respond. Many are watching closely for signs of retaliation or new trade barriers that could further disrupt global commerce. The unpredictable environment makes forecasting oil demand difficult. Analysts are revising their outlooks, unsure how long the standoff will last or how severe its effects might be. The market's reaction reflects a collective fear that the global economic engine could soon lose steam. If trade tensions persist, the slowdown could be deeper and more prolonged than many expect. Oil prices fell as traders priced in the risk of a slowdown, highlighting just how interconnected global trade, energy markets, and economic confidence have become in today's world. The new U.S. tariffs specifically target major exporters like South Korea and Japan, two countries that have built their economies around global trade and manufacturing. These nations rely heavily on access to the U.S. market for their electronics, automobiles, and machinery, making them especially vulnerable to any changes in trade policy. When tariffs are imposed, the cost of their goods rises for American consumers, which can quickly lead to a drop in demand. The tariffs also extend to smaller economies, such as Serbia, Thailand, and Tunisia. While these countries may not export as much as the larger players, their industries are often more dependent on a few key markets, making them highly sensitive to trade barriers. For all these countries, higher tariffs mean their exports become less competitive, which can force companies to cut production or even shut down factories. This leads to job losses, reduced incomes, and ultimately, slower economic growth across entire regions. As manufacturing slows, so does energy demand. Factories and shipping companies use less oil. Idle machinery and fewer shipments translate directly into lower fuel consumption. The impact is especially significant for oil-consuming nations like South Korea and Japan, which import large amounts of crude to power their industries and transportation networks. A slowdown in their economies means a noticeable drop in oil imports. If their economies contract, global oil consumption drops. This effect ripples outward, affecting oil producers and exporters around the world, not just in Asia. Even smaller economies feel outsized effects, as access to the U.S. market is crucial for their growth. For many, the U.S. is their largest or most profitable export destination, so any disruption can have a dramatic impact on their economic stability. The chain reaction is clear. Weaker economies abroad mean less oil needed worldwide. As ships sit idle and factories slow down, the global demand for energy contracts, sending signals throughout the oil market. Oil prices are forward-looking, so traders adjust expectations for demand as soon as trade tensions rise. Even the anticipation of lower consumption can trigger price swings. The new tariffs cast a cloud over the economic future of key oil-importing nations, creating uncertainty for businesses and investors alike. This pessimism can drive oil prices lower, even before any slowdown is measured. Markets often react to sentiment and forecasts, not just hard data. The market is quick to react to the threat of reduced demand, with traders and analysts watching every development for signs of further disruption. The recent U.S. tariffs have sparked widespread fears of a global economic slowdown as countries brace for the risk of retaliatory measures and a new wave of escalating trade barriers. These policies have not only heightened tensions between major economies like the U.S. and China, but also sent shockwaves through international markets, making investors and businesses increasingly wary about the future. Disrupted supply chains, higher business costs, and shaken consumer confidence could all contribute to weaker global growth, or even recession. As factories slow production and retailers see fewer customers, the ripple effects can be felt across industries and borders, impacting everything from manufacturing jobs to local economies. In today's interconnected world, tariffs make international business more expensive and less efficient. Companies that once relied on seamless global trade now face uncertainty, delays, and increased costs, forcing them to rethink their strategies and supply chains. As a result, companies may delay investments and cut production, reducing energy use and putting future growth at risk. This hesitation can stall innovation and slow down expansion plans, further dampening economic momentum. For oil markets, a global slowdown is the single biggest threat to demand. When economies falter, the need for energy drops sharply, leading to falling oil prices and uncertainty for producers. Oil consumption rises with economic growth and falls when economies contract. The link between economic activity and energy demand is direct and immediate, making oil markets especially sensitive to global trends. Even a small drop in global GDP can mean hundreds of thousands fewer barrels needed daily. This seemingly minor shift can have outsized effects on oil prices and the broader energy sector. The uncertainty itself is damaging. Businesses thrive on predictability, and the current climate is anything but. Volatile markets and unpredictable policy changes make it difficult for companies to plan ahead or commit to new projects. Cautious companies may hold back on spending, creating a self-fulfilling slowdown. When investment dries up, job growth stalls and consumer spending weakens, deepening the economic malaise. This cycle of fear and caution is already weighing on oil prices, as traders anticipate lower demand and brace for further declines. The market is bracing for tougher times ahead, with analysts closely watching every new development and policy announcement for signs of relief or further trouble. Tariffs have cast a long shadow over the energy outlook, leaving the industry and the world waiting anxiously to see what comes next. While demand worries grew, OPEC Plus announced a major supply-side move of 548,000 barrel per day production increase for August. This marks a shift from their previous, more cautious supply management. The group is unwinding earlier cuts, now restoring nearly 80% of a prior 2.2 million barrel per day reduction. The decision aims to meet strong current demand and prevent prices from rising too high. More oil on the market puts downward pressure on prices, especially when paired with trade war fears. Analysts expect another production hike in September, which could nearly erase all earlier cuts. The timing of this supply boost, alongside tariff news, created a powerful 1-2 punch for oil prices. Most of OPEC Plus's new supply will come from Saudi Arabia, the group's largest and most reliable producer. Saudi Arabia's ability to ramp up output quickly makes it the de facto leader and stabilizer of the group. The kingdom recently raised prices for its flagship crude in Asia, signaling confidence in regional demand. By leading the production increase, Saudi Arabia ensures the group meets its targets and maintains credibility. Not all OPEC Plus members can boost output, so Saudi leadership is crucial. The market trusts Saudi Arabia to deliver, giving the supply announcement real weight. This certainty helped cool oil prices immediately. Saudi Arabia's actions are a key signal for global energy markets. OPEC Plus's headline production increase may not fully materialize. There's often a gap between quotas and actual output. Some members, like Iraq and Kazakhstan, have already been overproducing and may not add much more. The real increase will depend heavily on Saudi Arabia and its Gulf allies. This gap between promised and actual supply helps support oil prices, preventing a steep drop. Traders know the market won't be flooded overnight. Ramping up production takes time. Recent data shows OPEC's output is rising gradually, not dramatically. The physical market remains relatively tight, even as more supply is promised. This reality tempers the bearish impact of the official announcement. Amid global uncertainty, strong U.S. oil demand is providing crucial support for prices. Over the July 4th holiday, a record 72.2 million Americans traveled, with 61.6 million by car, a direct boost to gasoline demand. This surge helps absorb extra supply and keeps prices from falling further. U.S. crude and gasoline inventories are below seasonal averages, signaling robust consumption. Tight inventories support West Texas intermediate prices and, by extension, global benchmarks. Financial markets reflect this optimism. Hedge funds have increased their bets on rising oil prices. The strength of U.S. demand is a key reason the recent price dip has been modest. Without it, the combination of tariffs and OPEC Plus supply hikes could have triggered a steeper decline. The American market remains a vital pillar for global oil. As long as U.S. demand holds, oil prices are unlikely to collapse. The world is watching U.S. consumption as a barometer for the market's health. This week's oil price dip reflects a tug-of-war between fears of a global slowdown and strong current demand. President Trump's new tariffs and OPEC Plus's supply boost created clear downward pressure. But doubts about whether OPEC Plus can deliver the full increase and robust U.S. demand have kept prices from falling further. The market is now watching three key fronts: trade negotiations, actual OPEC Plus output, and the sustainability of U.S. demand. The balance between future fears and present strength will dictate oil prices in the coming weeks. Volatility and vigilance will define the market as these forces play out. The direction of oil prices remains uncertain, hinging on how these competing factors evolve. For now, the market stands at a crossroads, awaiting the next move.